Sorry about the slight delay. We have Kavisha and Tarushi. Salma, I think I know you, but Kavisha and Tarushi, are you all joining in new for the session? Or have you all joined in for the revision? What's your progress? Yeah, Kavisha and okay. Is it Kavisha or Kavisha? Now it's Tarushi division. Okay. So, in terms of our progress, just into the people who are joining in today, we have this last section to complete, which I believe should take us around an hour, hopefully less than an hour, but around an hour. And the revision will start thereafter. So this last section, which is valuation of debt and preference shares, is something that we will quickly cover. It won't take us too long because these are basics that we've learned in cost of capital, right? So how do we address it thereafter? 19 is ratios, so we'll do a question covered of that, right? Okay. So let's get started, right? Tarushi, I didn't get a response from you. Hoping to get something from you as well. But anyway, Salma, you're okay? How's the progress going? Studying okay? Confident now? Didn't start, okay. Confident. Can get through. Okay, so let's move on to valuation of debt and preference shares. So again, stemming back from our cost of capital chapter, what did we say under cost of capital? We said let's consider that the market value of an investment is then equal to the present value of its returns, discounted at the investor's required rate of return. So if you go back to that equation that we learned, so what we are saying then is the market value of an investment is equals to the present value of returns discounted at the investor's required rate of return. I think we agreed to that. And this is something that we used as the basis for our chapter, cost of capital. So when it comes to valuations, very straightforward, use the same equation. So valuation of debt or preference shares, we're looking at preference shares initially. So if you put it into the equation, so your market value of preference shares has to be ideally be equal to the present value of dividends. Discounted at what? Discounted at preference shareholders required rate of return. Very simple. So market value of preference share would be your market price per share divided or equal to the present value of dividends. So take the dividends. We assume dividends grow into perpetuity or go into perpetuity rather. And discount at your shareholders required rate of return. So you can call it KP. Put notations into this. You can call this P naught, D naught, KP. Always remember, for preference shares, how do you calculate dividends? Dividends is equals to the percentage into nominal value, right? To nominal. Okay. Shareholders required rate of return. Come. Not working. Now it's okay. Thank you. Okay, finished. Okay, work out example 9. A firm has in issue 10% preference shares with a nominal value of 0.5 each. The required return of preference shareholders is currently 13%. So technically, if you look at this, it is a revision of your cost of capital also. Simply because it's the same equation, right? So when we do questions for cost of capital, please ensure that you have done your revision. Finished? How much do you get? Yeah. Let's further know how much do you get? 0.38. Okay. So your market price per share is equals to your dividend. So 10% dividend into your nominal value divided by 13%. So this you said is 0.38. Okay. Should be okay. Yeah. Right. So we move into your next one, which is irredeemable debt. What is the main characteristic of irredeemable debt? Main characteristic of irredeemable debt. Yes, we are arm's length away from the exam. If you don't know the main characteristic of irredeemable debt, I think all of us have to get some sort of redemption. Did I confuse you with one more? Good. Right. So what is what is what is the main characteristic of irredeemable debt? Kavisha, Salma, Tarushi, what can also answer? Yes, Abdullah. Okay, there's interest that is going to be paid in perpetuity. So which means you don't have a return back. You don't have a repayment of the principal. So when you put that into the equation that we learned now, you're looking at market value of your irredeemable debt is equal to what then? The present value of returns. So present value of interest. And here you will discount at debt holders required rate of return. Put notations into this equation, market value of debt. So you can say market value of debt is then equal to the present value of interest. Interest is received in perpetuity, and you divide by debt holders required rate of return. It can be KD. Okay, let's take it down. You can try out example 10 as well. What did you get there? How much? How much? 180. 1.2. 1.2. 1.2. Okay, so what they say here is irredeemable loan notes with a coupon rate of 6%. But before that, let's take one step back. Ask yourself the question, how do you calculate interest? How do you calculate interest? So if you ask yourself this question, how do I calculate interest? Very simple. Take your interest percentage and multiply it by nominal value. Okay. Then ask yourself the question, what is the nominal value? In most cases, $100 per loan note. So if you use this concept into your question, your market value of debt would be a 6% coupon rate into $100 divided by the required rate of return at 5%. This should give you 6 over 5, 120. 120. Okay. So by the looks of it, when you said 1.2, I believe you must have not multiplied by 100. Okay. So you can't forget this basic. Right? This is basics. So we've been looking at this some time back. So make sure that we're revising. Okay. So good. I think Salma, you got it right. So don't stress out. Don't stress out, right? Because we are still 1 month away from the exam. Don't stress out. Like I told you last time, always consider an exam to be something that you enjoy. Like when you go to the beach, you have to be careful. See, I mean, the beach you enjoy, no? But you have to be careful of, crabs coming and biting you, or, currents pulling you into the middle of the sea and making you drown, or someone stealing your valuables. But amidst all that fears, you still have fun, no? Tell me anyone who goes to the beach and doesn't have fun. No one. Right. Some of you might be scared of dogs. You will see a few dogs in. You still have fun. Ultimately, you come back home and ask yourself that question: did I have fun at the beach today? Yes. So when someone asks you, did you have fun at the exam? Answer has to be yes. So I have now decided I'm not going to ask my kids, how was the exam? All I'm going to ask is, did you have fun at the exam? Because then it removes the pressure of people. So tell your parents also not to ask, how was the exam? Tell your parents to ask you, did you have fun at the exam? Right? So first important is to enjoy your exam. Results come secondary. Okay? It's an output of your input. Okay. Then you come to redeemable debt. So what is redeemable debt? Give me the main characteristic of redeemable debt. Redeemable debt. Main characteristic. Sorry? Redeemed at a premium, cannot be also. So you can redeem at a premium or redeem at par also. So what is the main characteristics of this thing? Sorry? You can recover your capital back. Okay, so you have a redemption or you're redeeming the principal amount. Okay, so if you write down an equation for redeemable debt, then what would your equation look like? So your market value of redeemable debt would be what? Present value of interest plus the present value of redemption Okay, all of this discounted at investors required rate of return. So looking at this, how do you work this out then? Now see, I assume you can recall. If you can't, you will have to then go back to the recordings and look at it, right? But when we did redeemable debt at cost of capital, or in the chapter cost of capital, what we were really looking at was how do you calculate the cost of debt, or how do you calculate this investor's required rate of return. So we rearranged this equation, we did quite a bit of an analysis, we came to a conclusion that we need to calculate IRR. Correct? We've done that. So we came to that conclusion to say we have to calculate IRR because we said that this equation resembles the equation of an NPV where NPV is equal to 0. That's how we came to that conclusion. Okay. So in this instance, we don't have to calculate IRR because our objective is not to calculate the required rate of return. It is not. But rather, what is it then? Here, we are trying to calculate market value of redeemable debt. So if I was to calculate market value of redeemable debt, it's a very simple thing that I need to do. I know my required rate of return now. This is what I'm trying to find out. I can then calculate present value of interest, very straightforward. I can add the present value of redemption. You don't have to work out an IRR and all of that. Very simple, straightforward. Got my point. But under cost of capital, you knew the market value of redeemable debt and you were trying to figure out what is this required rate of return. At that instance, you had to calculate your IRR. You're clear with me now? Okay. Right. So in terms of your redeemable debt, I've already given you the equation on top. That is your equation. But don't forget, this will be an annuity. Okay. And redemption will be a one-time cash flow. So when you're dealing with annuities, you know how to calculate the annuity factor, or you can refer your tables and apply it into this equation. Discount factor or redemption is a one-time cash flow. You can use your present value tables or a formula to figure out what that value is. Okay. So I'll leave you with example 11. Please see if you can quickly work it out. Okay, so how much do you get there? So present value of interest. So it's a 8% loan note into the annuity factor at 12%. So was that 4.56? 4.7 years, right? 12% for 7 years is 5 point.
So
12% at 7 years. No?
5.26.
Sure.
No, 8%.
No, you look at 12%. No. Why are you looking at 8%? Okay. Okay. And then your present value of redemption. In this case, they're saying you're going to redeem at par, or we'll assume it's at par, or which will be at par. That's it. So $100 into 0.452. This is 45.2. I can figure out the present value of interest. Huh? How do you get 4.52? So 12% for 7 years. So this is a one-time cash flow. No? So then not only the first year. So this is happening in the 7th year, no? You're forgetting basics, no man.
So they have to add that and divide by the
Now see, now why do you have to divide or anything? Now what did I tell you in the above equation?
percent that is to add. And I divide by the
Why divide again?
to find the market value.
Now that's what I gave the equation on top. Market value of redeemable debt is what? Present value of interest plus present value of redemption. What I'm telling you is, for you to calculate a present value, you need a discount rate. That discount rate is your investor's required rate of return. I clearly told that interest is an annuity, redemption is a one-time cash flow. So when you have a one-time cash flow, you go to the particular year. In your, I told, use your present value tables or your formula. Okay. Right. So 8% into 100 into 4.56. How much does it give you? 36.51. 51? 5. Okay. So add this up. So you get something like 81.7. So this here is your market value of redeemable debt. Now don't forget basics. Huh? That's the difficulty. So then I have to teach the whole syllabus once again. It's rather impossible. Okay. Okay, finished. Okay, so the last one is looking at something called convertible. Now, what is the main characteristic of convertible? You're given an option. What is the option? Either to redeem your debt or convert the debt into equity. And how do you make your decision between redeeming and converting is based on a comparison of future values. What is that value in terms of redemption you're going to get, let's say at the end of 6 years, example, and how much of equity that you can get at the end of 6 years. If your equity value is higher, you will convert. If your equity is less than the redemption value, you will redeem. You'll always be a rational investor. So once again, for convertible debt, it is going to be very similar in terms of your formula for redeemable debt. Why? You're getting something back. What you get back can change between debt and equity. So you will have to make that choice at the exam. You have to show the workings to the examiner to say, okay, why you decided to go ahead with an equity conversion or why you went with a redemption. Okay, I think we did something very similar when you came across cost of capital in your previous chapters. Right. So a few other things that you might be asked with regards to convertible debt, I have listed out here. One is the flow value. What do you say flow value is? Flow value is your minimum value, or rather your market value without a conversion option. So when you say without a conversion option, what does it become? This then becomes the same as what? Same as? Same as what? You're a sleeping man? Redeemable debt. What happened today? All of us sleeping. Huh? Okay. So this is one thing that they can ask you. Determine the flow value of your conversion. So that means you assume there is no conversion option. You're going for redemption and you calculate it. So it then becomes the same working as for redeemable debt. No change. Then next you have something called conversion premium, which is your market value minus your current conversion value. What does current conversion value mean? Current conversion value means value if converted today. Value if converted today. Okay. Are we okay, everybody? Okay. Look at example 12. See if you can work out something. It can be wrong. Like I said, don't fear to be wrong. But your principles can't be wrong. Okay. Your principles can't be wrong. Okay. Right. If the answer is wrong, no problem. Ensure your principles are correct. The market value is today's market value.
which we calculate.
Now, what you understand here is market value. This market value you're calculating,
On the current,
this is today's value. That is why you're calculating the present value of interest. If it is the future value, you don't have to calculate the present value of interest. What it is worth today is based on what it will give you in the future. But obviously you can't use the future values because of the time difference, so hence you discount. So what you're calculating is your market value today, nothing else. Okay, finished. Okay, finished. How much to get?
62.6.
162.
So we have to choose the higher of the PPIM in the share.
Yeah. How much to get for that? Huh? 37.28. There are miles apart. Like today when I went to the Polo to buy carrot, he told me 350 rupees for 250. So I told him last week I bought for 170. The same guy. Like that took me this answer. It's 160 and 30. 100 times. Almost 100 more. Yes. What did you get? Huh? Okay. Salma, what did you get? Kavisha and Tarushi. Salma also got 36.75. You also got 36.75. Okay. Okay, let's do this here. Let's do the question. So they're asking you calculate the market value of the loan note. So what is the market value of the loan note? First thing is figure out equity versus redemption. Okay. If I go for the equity option, what do I get? As per the question, they are saying you're going to get 20 ordinary shares at what price? 4.25, growing at 7% each. So I'm going to take it as 4.25 growing at 7% each year. For how many years? 6 years. So when you calculate this, how much do you get in terms of value? 127 point? Can't hear. 5 exactly? Okay.
127.6.
Exactly.
127.56.
56. Okay, let's say 56. Okay. 127.56. Then if you do a redemption, what do you get? They're saying you're going to redeem at 5% premium. So you're going to take 100 multiplied by 1.05, you get 105. Okay. As a rational person, what would you like? Equity. As a rational person, you have to be rational. I don't know personally whether you are rational or not. If you're radical, I can't help it. But rational people will select 127.56. Why? Because? Okay. So therefore, you can say consider conversion instead of redemption. So it's very clear why we select conversion option. Then I told you calculate the market value. How do you calculate the market value? Present value of interest and present value of redemption, but this is conversion, right? So market value will be equal to present value of interest plus present value of conversion. Okay. So present value of interest is how much? You are paying how much? 9% of interest into $100. This into what is your discount rate? In this case, they are saying you are having 14% discount rate. So 14% for 6 years. What is your annuity factor? 3.889 plus present value of conversion. How much is your conversion? 127.56 into point how much? 456. 456. How much is this? Okay, so 35 plus
58.
58. 17. Let's say 18 or 17. 17. So when you add up, you get 93.17. How did I go wrong?
So I didn't discount the conversion.
Why? What did you do? You forgot to add the conversion value. Why? Okay, what did you do? Salma, what did you do? You also worked out redemption without taking conversion option. But did you do this analysis on top? Fatima? You didn't do that. Okay. Okay, now calculate the flow value and the conversion premium. Now flow value, you should have it based on what you said, right? You didn't consider the redemption, sorry, conversion, you consider redemption. That's your flow value, no? What is the flow value now? 35. No, but you did it before. Correct, that's what you did before, right? You said you didn't consider conversion, you consider redemption. But it can't be that different from 93. Okay. Okay, calculate the flow value. Isaac, you okay? Huh? She said, Salma has said 80.6. What did you get? 80.6. You got 82. Let's see, I don't know. So flow value, 9% into 100 into 3.889 plus 105 into 0.456. How much do you get? Exactly 80.6 on this. So this is 35 now. We'll work out the rest. 105 into 4.56 is 40. 8. So you get 82.8.
82.8.
Yes, Salma, what happened? You didn't take 105, I think. You took 100. You took 100, that's the problem. I think Salma, you also took 100. Yes, that's the problem. Be careful, no? These are easy stuff. No? What? So you got it correct? No? You took 100, but you got 82. No, man.
0.456.
Huh?
Then the 105%.
You multiply by 105%. Same thing. That means you have technically taken 105. Yeah. That's okay. You can do that way. Conversion premium. Okay. Yeah.
I got 8.1.
8.17. Okay. What did you get? Salma, what did you get? So you take the current market value. So this is the equation you got to use, right? So current market value minus current conversion value, right? So market value, I think you got 93.17 minus current value of the conversion. How much is the current value of the conversion? 20 shares into 4.56. How much is this? 4.56? No? Sorry, 4.25.
8.
8.17. So if you consider it on a per share basis, 8.17 divided by 20 shares, how much? 0.2 something, 0.4, 0.41. Okay, so make sure that you write down the per share case also, because otherwise if they ask you in a objective type question, you'll come back to me and say, sir, it is. Okay, easy. No? Easiest thing is sir, it is. Very easy. Proof is also there, no recordings. You can go through all the recordings and take it to the courts. Huh? That's per share. You can take it to the courts and say, sir, in teach, you can sue me. Huh? No problem. I'll let you find a lawyer.
FOMC will expire.
It expires. Okay, but anyway, they should have it now, so you can use that. But anyways, in one of my lectures, I would have said, you know, I teach you the most important things, you have to do the rest. So my argument for you at the courts would be, have I not taught you enough for you to get 50 marks at the exam? You have to be able to defend that. I'm just telling you. If you decide to go to courts with me, that's my counter argument. Have I not taught you enough for you to get 50? Huh?
That's very
To me, I'm thinking too much. No, you don't know about these students, these things. These Gen Z fellows are the same. The parents call them, they're going to go. Problem, no? Anyways, okay. There she's going to be the lawyer. She's a lawyer, Salma. Salma is a lawyer. Another student here. She's says now I'll be the lawyer.
She will write the case.
Huh?
She. Yeah, that's.
They're suggesting that you're going to file the case if you fail. She won't file. She's my previous student from PM also. She did very well in PM. Okay, so she's definitely going to do well in FM. Okay, so that's it from this chapter, right? So we're done. I've got some questions, obviously from your Kaplan study text, which we're going to work now. Just put it onto the group. Kavisha and Tarushi, are you all on the same group? Sorry? Are you all on the group? The FM Jan part-time, that group, right? Yeah, you all are there? Okay, good. So this is obviously from Kaplan, but some of these questions you might not have in your Kaplan book. So just to avoid any discrepancies, I have ensured that I upload it. I extract those pages and share it with you, right? I need this girl's help now. Can you just, Fatima, call that girl? No, just call her. Phone. So we can ask her to do this uploading stuff. Then it's on June 6th, no? 1 month. Super. Sixth festival? 7th, no? Why going on the exam? Go to Bhagatare, 1 o'clock, Juma is over. By 1:30, 1:35 you will get there. Red Mosque is there.
Which?
Red Mosque.
Yeah, they are.
Which one? The Kalam Grand Mosque is closed.
Yeah.
Behind in the courts area, there is a mosque. Near Pudukkot area, there is a mosque. That's not the Grand Mosque, but near Pudukkot. Yeah. But the Kalam Grand Mosque is somewhere there. It didn't come. Go man.
If they don't get me,
Huh? So you call them and ask them how long you will elect it from. Excel sheet. You had some Excel sheet before. No?
Yes,
I mean, you said every year, every week you put a tab.
Yes, sir.
I think that came. This is mine. No, I didn't do this one. This is not mine.
Then,
This one. Ah, right. 1st of May. 1st of May? I didn't come on 1st of May.
so that is 1st of Jan, 5th of Jan.
No, 5th of Jan, I didn't use Excel. Okay, maybe. Date was.
That was the first class. January.
No, I started this in October, no? January, yeah, but this is not, okay, I didn't do it on January. Anyways, it's fine. I did recently, right? Yeah, we did in April. Okay. Right, I sent you the questions on your that group. Check to see whether you got it. The confusion.
That's working capital.
Yeah, cash budgets. I did a question on cash budget, so I've done it on this. But I didn't do it on 1st of May or 5th of January. You can read the date either way. Date is an issue. Technical issue. Okay, so if you take these questions that I've given you, we'll start with a hard question. That's the best thing to do. Or do you want me to boost your confidence by giving an easy question? Yes. Okay. Then we'll do this question. Okay, we'll do an easier one first. Then we'll do a harder one. Actually, these questions, there's nothing called hard. Just that something a little different. Okay, to get this question called HEBAC, if you go to that this one set of tubes I gave you, it's question number 216, HEBAC. Shall we go through? So it says, we'll just use this for now, go through the question. Okay. So it says HEBAC is preparing to launch a new product in a new market, which is outside its current business operations. The company has undertaken market research and test marketing at a cost of 500,000. As a result of which, it expects the new product to be successful. Now, first thing that you need to understand is what do you do with this 500,000? What is this 500,000? Market research and test marketing cost. It's a sunk cost, right? So in your answers, before you forget, you will write down we have to put it this way. Okay. Okay, so we can say here HEBAC question, HEBAC. So you can say $500,000 ignored due to sunk cost. I think I forgot to tell you all, for the revisions, bring your laptop. You get used to doing it on Excel. Okay, so ignored due to sunk cost. Then what happens? Then let's go back to Tute. So it says Quebec company plans to charge a lower selling price initially, then increase the selling price on the assumption that the new product will establish itself in the new market. Forecast sales volumes, selling prices, and variable costs are as follows. So sales volumes are given, selling price is given, variable cost is given. Selling price and variable cost are given here in current price terms before taking account of forecast selling price inflation of 4% per year and variable cost inflation of 5% per year. Incremental fixed costs of 500,000 per year in current price terms would arise as a result of producing the new product. Fixed cost inflation of 8% per year is expected. Okay, no problems. The initial investment cost of production equipment for the new product will be 2.5 million, payable at the start of the first year of operation. Production will cease at the end of 4 years because the new product is expected to become obsolete due to new technology. The production equipment would have a scrap value at the end of 4 years of 125,000 in future value terms. Investment in working capital of 1.5 million will be required at the start of the first year of operation. Working capital inflation of 6% per year is expected, and working capital will be recovered in full at the end of 4 years. Quebec company pays corporation tax of 20% per year, with the tax liability being settled in the year in which it arises. The company can claim tax allowable depreciation on a 25% for a 25% reducing balance basis on the initial investment cost, adjusted in the final year of operation for a balancing allowance or charge. Quebec company currently has nominal after-tax weighted average cost of capital of 12% and a real after-tax WACC of 8.5%. The company uses its current WACC as the discount rate for all investment projects. Calculate the NPV of the investment project in nominal terms and comment on its financial acceptability. Okay. So I'll give you a few minutes. I would like you to start on it. Always remember, start with your revenues, then your costs, find your taxable income, do your taxes, then bring in working capital investment and your capital investment or the investment in your machinery or whatever it is there. Okay. So I'll give you roughly around 8 minutes. Take a start, and then we'll compare answers. Okay. Okay. Start. Yes. after the tax. You can consider it before, but generally when you put it before, let's say you put it after fixed cost, then when you're calculating your taxable cash flows also, you will include that. To avoid that only, I do it after the, yeah, but for your syllabus, you don't get taxed. You feel that it's covered in the taxable relief. Yeah. Yeah. I have to cut. Thank you. Thanks. I don't know if you've got something similar. Just check. You have to work with this double. Okay. I'll put the investment always at the last. So that will help us avoid any confusion with regards to the taxation computations, right? So here our equipment is 2.5 million. And, and then we have a scrap of 125,000. So your net cash flows. This should be your net cash flows, right? Okay, Abdul, have you got this? Then you will discount your nominal rate, which is 12%. Uh, 0.893, 797, 712, and 636. Then present values. Therefore, your NPV, let's do some. We get 1198,443. Got that?
You share this group.
I shared the group, but what is the question you have? What is the question you have? Huh? You don't have a question. You got the answer. Why? Huh? Salman, Kavisha, Shafana. Okay. So you can say you have to always make sure you comment. So students generally keep the NPV like this and they feel that they're done. You can't. You have to always say that the NPV is positive or negative. Therefore, the project is feasible or not feasible, financially feasible or not, right? So you can say here the NPV is positive, and therefore the project is financially acceptable. always use the words financially acceptable, because there can be other non-financial factors which can make this project not feasible. Okay, so always use this format. Tip number 1 is always start with revenue, finish off your taxation first, then bring in investments. Now, to your question, Ishaq, if you had brought the scrap value of 125,000 before you calculate taxable cash, when you're calculating your tax in year 4, you will include 125,000 and calculate tax, which can be wrong. Okay. Okay. So requirement, then calculate the incremental.
So at some cost level, we have to say that.
Sunk cost, you have to say why you exclude. If there's anything that you exclude, you always mention to the examiner why you exclude it. Okay. Right. So they are saying discuss how the capital asset pricing model can assist HEBAC company in making a better investment decision with respect to its new product launch. Now, when you say capital asset pricing model, what do you think we should mention here? See, there's 8 marks, so you need to mention 4 marks into 2 at least. 4 points into 2 rather, 2 marks each, or 3 into 3 or something like that. Right? Just to ensure that you get somewhere close to the 8-9 mark. Now, students generally find it very lazy, after doing a lot of numbers, to do some writing. That's one reason students fail. They say, 8 marks. If you write something, you get 4 marks that can differentiate 46 to 50. Okay. Right. So, what shall you write here? What do you think you should write? Discuss how PPIM can assist them in making a better investment decision with regards to its new product launch. Something very key that I read in the top, I don't know if you've picked it up, was this sentence. Launch a new product in a new market which is outside its current business operations. When you're having something outside your current business operations, can we use the standard WACC? I think I gave you a small matrix. Remember, what was the matrix I gave you? In that matrix, I told you, put financial risk on the top, business risk on the side. You can consider this to be same or change and change. I told you WACC can only be calculated at this point. At financial risk remaining the same, business risk changing, you have to calculate something called risk adjusted WACC. I told you this is something that is very special that I tell my students. Can you go and find in any Kaplan book? It's not, they're guaranteed. Just the present. It's in your next syllabus, advanced financial. Okay. So I tell you, you have to always you come to class, there has to be something extra I give you apart from this. So these are some of the extra things. Now, whenever you have this matrix in mind, it becomes very easy. Now they have changed the business operations. Now, the moment I read that sentence, this came to my mind. but I didn't want to tell you because we can discuss it in section B. So now risk adjusted WACC. Now they're asking you, how will CAPM help you make a better investment decision? So first thing, I'm just going to give you points, not the whole note. So you can write down points. First thing that you're going to say is the question is using WACC. The question is using WACC. And WACC is most suited. This is just points, not the entire answer. Don't keep it like this at the exam. You have to put the huff and bluff and salt and pepper into it. Sorry, can you repeat what I said? Just lost my thoughts. Sorry? WACC. Which is ideal when you are in the same risk class. Same risk class. So I'm considering or referring both to financial risk and business risk both. Financial risk and business risk both. Then the second point you can say, using CAPM will help you with calculating a project specific discount rate. By calculating a project specific discount rate, which will help make a better investment decision. Point number 3, explain the process of project specific discount rates. Within brackets you can say finding a proxy company beta, or finding proxy company data. It's not beta, data.
So project specific.
Discount rates. Within brackets you can say finding proxy company data, de-gearing the proxy beta, de-gearing the proxy beta, de-gearing the proxy beta, re-gearing the beta, to match companies' financial risk, recalculate discount rate. So whole process you can quickly write down in few sentences. Finally, can conclude. Point number 4, conclusion. Put a dash and say, using project specified discount rates, will lead to better investment decisions. How many marks are divided between calculations and commenting? Commenting financial acceptability, only 1 mark. If you're referring to part A. Part B, I think clearly mentioned 8 marks. Please read near the screen, we can't hear you. Okay. Basically, don't walk. Right, done. Let's hit for a small break. 10:35 is the time. 10:55 we'll get back and continue with more questions. I told you to write it in full sentences. 8 marks is enough. Don't write too much. Examiners will feel good. Finished. For me. Finished. Finished. PV done? How much do you get? Okay. We'll wait for the others. I'll give you 2 minutes. Looks okay. Okay. I don't know if the answer is correct. Huh? My eyes, it looks okay. Did you consider, just one thing I'm asking, did you consider now, for example, in year 1, you can have 1 million, no? And year 2, you can have either 2 million, 3 million, or 5 million. Then again in year 1, you can have either 2 million or 2, 3, and 5. Have you considered all of that options?
Yeah. But three, there are the options.
1 year there are 3, but when it comes to year 2, there are 9. Have you considered all 9? No. Because year 1, you have 1 million. In year 2, you can have 2 million, 3 million, or 5 million. In year 1, if you have 2 million, again you can have either 2 million, 3 million, or 5 million. So there should be ideally, we say 9 permutations. Got my point, no? Okay, so see, they're asking you using a joint probability table. Joint probability table. Right, so what we'll do is we'll create a small table just like we normally do. So we can say, we'll say cash flows. Okay. What we'll do is we'll calculate the present values first, which might make it easy. So you have year 1 cash flows. So you have 1 million, 2 million, and 3 million. 1 million, 2 million, and 3 million. Then you can multiply your discount factor. In this case, your discount factor is 12%. Right, I think we have the 12% factors here, 0.893, 797, and 712. Oops, sorry, it will be the same, correct. So your present value, will come to the probability. There's multiple ways of doing it, so I'm just doing it this way. So you have the year 1 present values, which makes life a little more easier as we progress, right? So this will be year 2 cash flows. So year 2 cash flows, you have 2 million, 3 million, and 5 million. Okay. And this is 797. Okay, so you should get those present values. And this is what you did. Okay. Right. The problem is with your method, Isak, I think your workings are okay. Based on what I saw, but they're asking you a table, you have to show the joint probability table. Okay, so then you have 9 permutations. Okay. So we'll create a small table. So we'll start off with present value of year one cash flows. Right. So present value of year one cash flows, you have 893,000. So I'm taking this 893,000 there. So when you have 893,000 here, what is the probability of this 893,000 happening? Probability is 10%, right? So you can say 0.1. Then you can have present value of year two cash flows. So what is your present value of year two cash flows? The first option you have is 1,594. And what is the probability of this year two cash flows? This is 30%, right? 30%. Now, what you can look at is what is your total present value of these two together. Your total present value of these two together will be the addition of these two. Then you can take your joint probability. They want you to show a joint probability on the table. It's a specific requirement of this question. Both are present values. That's what I know. That's what you did. But let's look. Watch this, and then I'll come to your question. Huh? So 0.1 into 0.03 will give you your joint probability. That is, assuming that year one you have 893 and year two you have 1,594. So this will give you 0. There's a bracket at the back. 0.03 joint probability, right? Then what you can do is you can take your present value into joint probability, get 74,610. Okay. Now this is scenario 1. So we'll have to build scenario 1. So then scenario 2, I don't know how to use this. Joint probabilities now. Okay, let me show that first to you. So if you draw a tree diagram, you have year naught with you. That's where you are currently. Then you have year 1 and year 2. In year 1, you can have 3 options. Correct? No? You have option for 1 million. You have an option. You have 3 options: 1 million, 2 million, and 3 million. Year 2, when you have 1 million in year 1, you have 3 options in this. Then you have 3 options here. Then you have 3 options here. Huh? So what they're saying is, if you get 1 million in year 1, you can have either 2 million in year 2, or 3 million in year 2, or 5 million in year 2. Then if you get 2 million, you will have 2 million in year 2, or 3 million, or 5 million. Then you take 3 million, you will have 2 million, 3 million, or 5 million. So what they're saying here is, if you look at, okay, this probabilities. Now, I don't know how much of stats you have done, but probabilities will always add up to 1. Will always add up to 1. Sideways, it does not have to add up to 1. What they are saying is, if now let's say, for example, year 1 they had only given you 1 cash flow, and year 2 they had given you only 1 cash flow. No problem, straightforward, you can calculate it. Now they have given you, let's say they've given you 2. Then when you draw a tree diagram, space, but let me just draw it here. Okay, when you draw a tree diagram for 2 years, or for 2 options, you will have A here, you will have B here, Then when you go to second year, this tree will extend to A, or let's say, okay, let's say this is C, this is D. This will extend to E and F, just like how we did decision trees in your PPIM. So what will happen is your outcome can either be this, can either be this, can either be this, or can either be this. You can have a scenario where in the first year you have only one option, but in the second year you have multiple options. Then what you can do is, even if you draw a tree diagram, it's always going to do 3 branches only. So then you can simply take the second year cash flow multiplied by probability, this multiplied by probability, this multiplied by probability, and then add it to this. So you'll have only 3 permutations. But in this case, you have 3 here and you have 3 here. That will give you 9 permutations. Okay. And in this question, they are saying specifically joint probability table. Hence, you will not be able to use your method that you used. You have to show this column. So you have to show this column called the joint probability, because they're specifically asking for it. Otherwise, what you done is perfectly okay. 9 scenarios you have to show, because this will help you with your part 2, 3, and 4 of A. Okay. So what is your next scenario? You can again have 893. This is 0.1. And then year 2, you can have 2.39 million, which is 0.6. Right? So I'm just going to copy this down. How did I get? This one, 0.06. So joint probabilities, like I told you in the tree diagram, once you work sideways, your joint probability is the probability of A into probability of C. So the occurrence or the probability of this particular combination occurring is going to be A into C. This combination will be A into D, or this combination will be B into E, this will be B into F. You with me? Okay. Right. Then you can do the next one. Sorry? You don't have to, because you have to use a joint probability table. You can take the present value itself straight away and do it. Yeah. And this will be 3.985, which is 0.1. Right? Then you have the next scenario. Let's say scenario case 4. So here you will consider 1.786, where your probability is 0.5. This will remain the same. Oops. Okay. So to get because we can call this scenario 2 and this 3 separate scenario. So this is first scenario, where you have year 1 893, year 2 1.5. Second scenario, year 1, 893, second year, 239. Third scenario, this is fourth. Without typing everything, I'll just put it. If you want me to type everything, I'll do. Not an issue. Just that it's annoying enough to type. So this will be 4, 5, 6, 7.
911.
Yeah, so we're going to 9. So third one or seventh one will be 2, 6, 7, 9. Oops, something wrong here. This will remain the same at 1.76. This was 1.76. So you have three scenarios here. This will be 0.4. Then you get 0.954. 4391. Sorry? NPV with risk. Okay. Yeah. So if you want to calculate your total in PV, you can take the total. This is fine. Okay, total. You get 4.365. You can minus your investment value. What is your investment value? I think 3.5 million. $865. Same answer you got. As I said, your workings might be correct, but the methodology is wrong. Huh? 865,200. As I said, you must have got the same answer, but since you're asking for a joint probability table, you can't do any other method. They will definitely. Plus, it will help you for the next part. Now, if I ask you in the next part, do the working for the negative probability or probability of investment having a negative in PV, you're going to suffer. So you see the benefit of doing this working in parts 2, 3, and 4. Okay, right. So take it down and then we move on.
Joint probability, everything except what?
Yeah. No, joint probability won't add up to 1. Is it? I don't think that. Yeah. Interesting. Will add up to 1. Ideally, yes. No, 1 into 1 is 1. Because year 1 you're having 1 and year 2 also you're having 1. That's better up to 1.
What is it?
I said it in the record. Yeah, missed. Did I do something like this in class?
Yeah.
How come you are getting it wrong? Not detail.
Example.
I didn't say. The same example. I did.
No, he did 10. Not in 3,
Yeah.
but in less.
I was.
So-
I did.
Yeah.
I remember doing a question. But good, since you have forgotten it, then you're getting something back. Okay.
So you share the.
This one?
Yeah.
I won't share it, they will share it. Okay. Okay, now see the next part, negative NPV probability. What is the probability of you having a negative NPV? Probability of you having a negative NPV. Probability of negative. How? Don't. Now you have a fantastic tool in front of you. You have to use this tool to calculate your negative NPVs. So if I was you, what I would do is I would consider looking at my outcomes here and calculating for each scenario independent NPVs. Each scenario I'll calculate an independent NPV. Each scenario. What do you mean by independent NPV? Independent NPV in the sense, I have a total present value here, 2.487. That I will minus my total investment of 3.5. That is to say, if certainly I have scenario 1 happening, I have to have an NPV of negative 1,013,000. If I go ahead with, okay, let's take this one. Scenario 3, I will have 4.878 minus 3.5 million. Positive NPV of 1.378. This is assuming a particular scenario happens. Right? So now what you can do, that's the beauty of this. Do it this way, and then you can figure out that there are 3 scenarios. Scenario 1, scenario 2, and scenario 4 that gives you a negative NPV. So if I was to highlight that in red letters, red also. Okay. Let's assume this is red for the moment. Who invented Apple? Didn't know. I like how Apple says things different. So difficult to think different because you're trying to figure out how to do this. So difficult. Okay. So you have 3 scenarios where you have a negative NPV. So what are they asking in the question? Calculate the probability of the investment having a negative NPV. What is the probability of the investment having a negative NPV? You take the joint probabilities that you have here. Sorry, wrong color. Okay. These are the 3 probabilities. In statistics, there is something called or and AND. Have you heard of it? Or and, 2 terms. Right? If it is AND, what do you do? Huh? Multiply. If it is or, you will add. So when you in the tree diagram, what you said was A and C can happen. You multiply. If it is A or B, you will add. Now, for example, we said, okay, the probabilities are going to be equal to 1. You said you took 0.1 or 0.5 or 0.4 and you said, okay, total probability is 1. Which means when you say or, you are adding. In statistics, When you're reading something and you say and, you multiply. It might feel a little confusing because normally you say end is to add. But here, statistics is a little different, right? So, and means multiply or means add. Simple. Not really, but considerably simple. Now, when you read the joint probabilities, now you might be thinking, okay, do I add or multiply? So, you're saying it can be scenario 1, it can be or scenario 2 or scenario 4. These are the three scenarios in which you have a negative NPV. So, you're not saying scenario 1 and scenario 2 and scenario 3. All three scenarios can't happen at the same time for you to get a negative NPV. So, what you're saying is scenario 1 can happen, will give you a negative NPV, or you will have a scenario 2 which happens, which gives you a negative NPV, or can have a scenario 4 which happens, which gives you a negative NPV. So, if you're figuring out what is my probability of the negative NPV, what do? Add 0.03 with 0.06, which is 0.09, 0.09 plus 0.15 to give you 0.24.
Just
I said add. Add, sorry, not multiply. Add. I stick to add.
so at all.
Not all, only the three that you selected. Yeah, so that's what I said 0.03 plus 0.06 plus 0.0015. Huh? If it is equal probability, yes. It's not equal probability. Yeah. Okay. So we'll write a statement here. Probability of negative NPV occurrence is basically 0.03 plus 0.06 plus 0.24. Okay, comfortable? Huh? Okay, be happy. I say no, what I will do? You have to go, you have to go. You can just go, man. Huh? Yeah. Huh? It's cool. Okay, go. Habit. Okay, happy. Right, okay, next one, most likely outcome. What's the most likely outcome? NPV of the most likely outcome. What does most likely mean? Definitely going to happen. Most likely outcome. 0.24. 0.24 is highest. I thought 0.3 is greater than 0.2. Yeah, 0.03. What is this then? So this is your highest probability. So most likely outcome. Correct, what you all said is correct, but for some reason you all couldn't figure out what is the highest probability. So it will cost you 1 mark, but can't tell. Difference between 49 and 50 is also 1 mark. Then also you have to say can't tell. Okay, most likely outcome. Huh? Yeah, that's what I said. Very easy when you do it in this way. It is basically your highest probability, which will give you an NPV of 677. Okay, Salma and Shafana, Avisha. Okay, everybody is saying yes, sir, 3 bags full. I hope you all are really okay. Okay, sit for some time. Oh. Okay, good. Total 677,000. Yes, they're not asking the probability, they're asking the NPV of the most likely. Okay, no? Very clear, no? Happy? Yeah. So ultimately, the journey that you make every day to class has to be worth it. Huh? If you learn one thing, consider to be lucky. Yeah. Sorry, I'm not seeing you 125,000. Where is it? Yeah. They're asking the NPV, no? In column J, we have computed NPV. Okay. Okay. No problem. Okay, no? Happy. Salma, you okay? Shafana? Okay. Next part, they're asking you comment on the financial acceptability of the proposed investment. So, what do you say about the financial acceptability of the proposed investment? What do you say? Okay, happy? Happy to proceed? Why? What you can say is expected NPV. I think I forgot to write it here, but this is your ENPV, expected NPV. So, your expected NPV is positive 865,200, and therefore, yes, the project is financially acceptable. So, they are giving you multiple marks now, 2 marks. So, which means you need to write something a little more than that. Just saying financially acceptable might not be acceptable. Okay. So, what do you say? You have to put a debate. However, what are you going to say? Whenever you write something about expected NPVs, always make this statement. You have to say that expected NPV is a long run average. It's a long run average. It might not be the actual outcome that takes place. That has to be written. Whenever you write an ENPV answer, write that down. Okay. Whether the examiner will give you a mark or not is a different story, but just write it. No, I can't. Expected NPV is the long run average. Right? It's a long run average. Therefore, the actual outcome will be different to your expected NPV. I don't know if I said the same words before, but something along those lines. Okay. Then, but this question is giving you some more information. So use it. Use it. Ideally, what's going to happen to you is that you will end up with something from column J. One of those scenarios only will happen. Correct? You're not going to end up with 865, 200. Dead sure. Why? It's a long run average. What you will end up with is one of those 9 values that you have in column J. And there's a 24% chance you will end up with a negative value. Okay. You have to analyze. Huh? But use your brains a bit. Okay. So I'm going to say something a little different to the examiner to say that there is a potential, or you can say that the NPV, actual NPV, will be something of column J, the values in column J, of which there is a 24% chance of it being a negative NPV, which you have to determine whether is a acceptable value of 24% or too much. 25% is 1 in 4 chances that you're going to have a negative answer. So there is 1 in 4 chance that you're going to have a negative NP, which if you say 24% might feel low, but when you say 1 in 4 chance, sounds scary. It's like your MCQs, no? 1 in 4 chance only you get it correct. Okay? So it's scary.
So if we just say we can accept the project, we will put him on.
Yeah. 1 mark. No, maybe half mark. I just need to take this call. Yeah. Sorry. Okay. Happy? Okay. Okay. Part B. Discuss 2 of the following methods of adjusting for risk and uncertainty in investment appraisals: simulation adjusted payback, risk adjusted discount rates. Now, when students see something like this, they get very stressed out. People like to get stressed. No? They get very stressed out. Why? The first thing they see is simulation. I told you the story, no? I don't know if you watched the recordings. I told you the story that there's a students complained to me that there was a question on simulation. That's this question. Out of this 20 marks, only 4 marks is related to simulation, which is also optional. They made a big ha-ho to say that I have not taught them simulation. Because what they did not understand is part A, which they thought was simulation. That's not my problem. Okay. Your interpretation is not my problem. And part B, when I got this question, I just got hold of their necks and squeezed them so tight that they couldn't breathe any longer. Optional, no. If you don't know simulation, leave it. Go to adjusted payback and adjusted discount rates. Very simple.
Was this the question?
This was the question. Same question. This is past paper question, no? 2018. This is June 2018. Okay. So when you examiner, if you go to the, what's that site you all have now? Study Hub. You go to Study Hub, under simulation, there's a note from the exam. You will read it. It says no calculations will be done. But applicability or commenting or something will be coming. That's what they say. Which is what they have asked. Right? So don't panic the moment you see simulation. Don't panic. As I said, it has to be a a fun experience, an exam. Okay. Don't panic at the exam. Okay. There are so many people who have done ACCA, so many people have passed, so many people have failed, nobody's died. I have not heard a reported case of a death during an ACCA exam. Okay. I think in this world right now, I'm not being negative, but the best thing that can happen to you is death. So peaceful once you die, hopefully. Right? If you're going to heaven, it's going to be peaceful. So live a life that will take you to heaven and wish for a death. Huh? That lies in your hands, man. Huh? Why? If you know for your consciousness that you're doing everything good, no harm. No? Correct. Honestly, sometimes I feel, if you just die, it's so much peaceful. I'm not being negative. Huh? I'm not being don't go and commit suicide or something like that. What I'm saying is, I'm not being negative. I'm just saying the world is full of problems. One of the best things that can happen is death. For example, think of the people in Palestine. They are wishing for death. Right? What do you mean? That's different.
Yeah.
I know they're suffering, but why do they wish for death? Okay. I'm not being negative. I'm not saying that I'm happy, I'm unhappy, I'm a depressed soul. I'm not saying that, right? Don't misunderstand. As I said, your interpretation is not my responsibility. Okay, let's quickly write down small notes on this, right? Simulation, what you can say is, I'm just going to give points, points like last time. Simulation, you can say, a computer-based method of evaluating investment projects with probability distributions attached to it. Next one, you can say next point, the probability distribution is built based on repeated simulation runs. Full stop. Next line, you can say risk of the project can be determined through the standard deviations. Okay. And that's okay. Then you can say adjusted payback. Next one. This is basically a discounted payback, right? So you can say there discounted payback, which considers risk through the appropriate discount rates applied. Through the appropriate discount rates applied. You can say the next line. If risk increases, payback will have to be shorter. Payback will have to be shorter. To ensure cash flows are obtained. To ensure cash flows are obtained. Ensure cash flows are obtained closer to the investment date. Closer to the investment date. Okay. The last one is risk adjusted discount rate. I think we referred to that in the previous answer on the HEBAC. Right? So you can write down the same thing. Okay. Right. Let's go into the next question. Can I come again? Couldn't hear you much. Actual? Yeah. No, you can't take it like that because those are independent scenarios. Okay, let's look at this question called DINK company. DINK. Same topic. It's two different aspects. Simulation is the advanced version of sensitivity. Sensitivity, only one variable changes. Simulation, all the variables can change. Tested. Numbers will be tested. Okay, let's go to DINK. So it says DINK is a small company that is finding it difficult to raise funds to acquire a new machine costing 750,000. DINK would ideally like a 4-year loan for the full purchase price at a before tax interest rate of 8.6% per year. Okay. The machine would have an expected life of 4 years. At the end of this period, the machine would have a residual value of 50,000. Tax allowable servicing costs for the machine would be 23,000 per year. Tax allowable depreciation on the full purchase price would be available on a 25% reducing balance basis. A leasing company has offered a contract whereby DINK company would have to use some of the new machines for 4 years in exchange for an annual lease rental payment of 200,000. Payable at the start of each year. The contract states that the leasing company would undertake maintenance of the machine at no additional cost to DINK company. At the end of 4 years, the leasing company would remove the machine from the manufacturing facility of DINK. DINK company pays corporation tax of 30% 1 year in advance. For the new machine, calculate the present value of the cost of borrowing to buy, present value of the cost of the leasing option. Recommend which option is more attractive. I think you can do that. Lease versus buy. We didn't know. Hmm? No revenue? Yeah, because that will be taxed. Then here you're not calculating your tax also. You're only calculating your tax benefits. So what's the discount rate we're going to use? Hmm? Post tax, yeah. So you can say post tax discount rate. Do small working. Post tax discount rate. That is obviously going to be KD into KD 1 minus. Which in this case will be KD is 8.6 into 1 minus T. 8.00602. So let's say 6%. Discount rate at 6%.
But then we don't calculate interest.
Hmm?
Just
This is the interest rate. I don't know how to use this. Anyways, this should be one. What's the discount rates? %, 0.943. 840. Okay, so here you get present value of cost of borrowing. Get 597,277. Yeah. But they're saying the question tax allowable servicing costs for the machine would be 23,000, which means you have to get a tax relief from that tax. Okay, good. Salma and Kavish, good. So next week we'll do working capital. And the week, sorry, next week Saturday no class, Sunday no class. We'll do it on Tuesday. Oh, you know, Tuesday. Okay. If Sunday won't be there. Tuesday, Sunday no class. You also go on holiday. Salma and Kavita, next week, Sunday no class. We'll have on Tuesday. If there are any changes to that, I will let you all know. But for now, it's not on Sunday. Okay, do the lease option also.
So same. KV.
Hmm?
Same KV.
Same for lease. Yeah, they haven't given anything else. No? Only that interest rate. Use that. Generally, there can't be a difference. Other you can't evaluate. No? Is the reason? You get 538, 460.
Questions. Are the questions on this tax review?
For lease option. Lease option tax relief is there. If you refer to the tip I gave you, the for lease under that tax relief for lease option is given. So next week revise, next week when I send Tuesday. Okay, so revise and come working capital. Hammer it. I'm not happy with doing 3 questions. It has to be 6 questions in the class. So we have 4 hours, 4.5 hours actually, or 4 hours, let's say. 4 hours. If you take 20 minutes out for your break, which we don't really need, and your revision itself like a break, no? Casually, no need break. Revision, nothing new is going to the head. It's revision. It will be a fun exercise.
Tuesday is next week Tuesday or week after?
The Vesak Poya, Tuesday, 11th, I think. No? Good question. What revision approach is good for financial management? Focus on NPVs, working capital, business valuations and cost of capital. Risk management. Focus on those 4-5 areas along with business valuations. 5 areas. Master those. Those will come for section C, which you can score 20 marks. So 20 and 20 is 40. After that, failing the paper is due. So I'll give you more tips as we go on, but for your revision, start with the investment appraisals. Then go to, so the financial management paper, there can't be a question without investment appraisal. Whether it's 2 marks or 20 marks, I don't know, but there can't be a question without it. There can't be a question without cost of capital. 2 marks or 20 marks, I don't know, but there can't be a question. Business valuations also will be tested. Risk management has to be tested. Right? But working capital most likely will be tested. So see, you master these 5 areas, 2 of which will come to section C, which means you are securing 40 marks before you go to the exam. That has to be the goal. Huh? Secure 40 marks before you go to the exam. Okay, Salman. We'll do a mock. Or we can do this, no? Next week, Sunday, we'll have the mock. Yeah. No, so you can do the mock, no? Since we don't have class. Wholesale.
Oh,
Wherever. In the bus stand or in the bus or wherever you are. Not a problem.
what we can do?
Not if you have to do. Then I can mark it. I won't be able to mark it on Tuesday, but next week Saturday I can mark it then. Then next week Sunday we can discuss. It's a good approach. Don't waste your time. We'll do a mock timed 3 hours. I'll give you half an hour extra to upload the paper. No, bad option. After you have studied, don't worry. So what you do is, okay, we'll do this. I'll give you 4 hours for the paper. Okay. Try to do it open book. Okay, no? Mock exam, open book. Because whether I say open book or not, when you're at home, you will open the book. No? So might as well make it legal. Then you are not guilty that you're opening the book. Correct? No? But try as much as possible to do it without. Do the mock and submit online. So I'll give you 4.5 hours. one additional hour because you have to operative find the book and see where the paper is. You don't know those things generally. And then but you can't do ChatGPT. Yeah? You can't upload the question on ChatGPT, ask him to give you the answer. So what happened was, what? He'll give wrong answers. I tried that. I gave a mock exam to my RI students and I went home back and I said, okay, let me see what ChatGPT is going to give to this answer. So I put a question up, copied the entire question, put it onto that, formatted it so he can read it properly, and I sent it. Then the first part he got correct because that was a ratio calculation. Second part, third part wrong. Then I wrote, you might have gone wrong here, you might have gone wrong here. Yes, thank you for that insight. This is wrong. Please find the correct answer. I went back and told my students, if any of you have put it on ChatGPT, now I know you'll get the wrong answer. But luckily those guys have not put it on ChatGPT. They were honest. I'm not saying you're not honest, but
That's like we did a work, and to mark the work, like I put the check the correct answers, I put it ChatGPT, and the answers were different from Sir's answer. And then Sir was like, you should ChatGPT is perfect.
yeah, it's wrong. Don't do that. That's a bad habit. Okay. So we'll do that then. So Sunday mock, open book. But 4.5 hours paper has to be in my email. If it is not, I am not marking. Last time when I gave PM, they were like, sir, sorry, sir, we got late. 12 hours late also they're sending the paper. Specific time. Class is 4 hours, no? Might as well do it in those 4 hours, no? There's nothing else no to do on Sunday morning. See, ideally there's nothing else for you all to do on Sunday morning. Hence you all are here, no? Not because out of choice you all are coming here. No? You have nothing else to do, hence you all are here. Correct, no? So you have this whole week to study them. Okay, so don't worry. Salma says ChatGPT doesn't know ACCA calculations. Correct. Okay, recommend which option is more attractive in financial terms to DINK company. So what is more attractive? Ideally, lease option. So you write a statement to say lease option is better. They're only giving 1 mark. So don't try writing stories. Just say lease option is better. If you want, you can say by how much. That's the difference between these two. It's around 40,000. Not 40, 50,000.
So she said ChatGPT doesn't know ACCA. Doesn't.
Listen. She must have tried.
She said, yeah, it doesn't.
Okay. Next question is asking, discuss general reasons. Very interesting question. General reasons. Can be right, can be wrong. No? General reasons is what you feel is correct. You write. You will definitely get 5 marks. Why investment capital might be rationed. I have given you this in your tutor also. Right. So you can talk about soft capital rationing. You can write down points. Soft capital rationing and hard capital rationing. Talk about both types of rationing and say reasons. So reasons for hard capital rationing might be because a company doesn't have good financial stability, investors are not confident in the company, maybe they have high gearing, so on and so forth. Right? Soft capital rationing because obviously internal people make the decision not to go for a additional borrowing. Right? Maybe they don't have enough resources, maybe they don't want to increase the gearing ratio, so on and so forth. Right? Next part is asking, discuss ways in which external capital rationing experienced by DINK company might be overcome. So when you say external, they're referring to hard capital rationing. So what is the external methodologies you can use? So this is ways of finding finance. So your traditional means are not going to help. That's what they're saying. In the hard capital rationing, traditional means are not going to help you. So what are you going to do different? So you can write down a few points maybe. One is look at maybe a joint venture option. I'm just coming up with random stuff. Joint venture option. Ask someone to take part of your shareholding. Maybe find a maybe you can do this. You can do something called crowdfunding or peer funding. Ask friends or put a public advertisement to say fund your company. Then you can say find a business investor, or we call it an angel investor. Angel investor.
So angel investors, they usually invest in
Small companies with high potential for growth. Startups. If you watch Shark Tank and stuff like that.
Is that real?
Yeah. What do you mean? Not real?
No, I thought that's fake.
No, that's real. Real companies. There's a Sri Lankan guy in Shark Tank Australia who got a really good deal. He did a mattress company. What's that fancy? Yeah. I can't remember whether anyone invested in the company or not. The concept was very interesting and the investors were interested in investing. The last bit I can't remember whether they actually invested. Okay. Okay. How many points did I give? 3? That's in 6 marks. No? Gave you 4 marks. So I give you 3 now. That should be. Okay. We'll stop there then. We'll catch up next week. So next week, Mokka. Come and remind me on Saturday. Rather Friday. So that not prepare. No, I don't have the mock. I have to get a mock. Yeah. For PM last time I made the mock and I set it up. This time I might have to do the same. I couldn't find a mock exam. Basically I have to find something that you are not having access to. No? There's no point. You can look at the marking scheme and do it. And when you're doing the mock, do it in Excel. Don't do it in Word. Don't send me multiple files. Do it only in Excel. Every question has to have a new tab. Section A is all objective types. No? So what you can do is open a tab like this. You can say section A, question 1, 2, 3, 4, 5, go downwards. Right? And write your answers. Open a new tab, section B, question 1. New tab, section B, question 2. New tab, section B, question 3. Section C also 2 tabs. First question under section C and second question. So altogether you should have 6 tabs. Huh? Don't send me 2 documents, only 1 document. Only Excel. Yeah, section A1, section B, question 1, question 2, question 3. Section C, 1 and 2, 6 tabs. Don't send 6 Excel files. Huh? Please, only 1 Excel file with multiple tabs. I hope I'm very clear. English is clear now? Okay. Thank you. See you tomorrow. Sorry, next week.